this is related to net present value, and related to the payback period. Okay, we need to see after how many years we will get this 450,000. In the first year, we will get 190,000. In the second year, we will get also 190,000. That means in the second year, we will get how much? In the second year, we will get around 380,000. Then how much the remaining for the 450? The remaining is around 70,000. But here in the third year, we are not returning only 70,000. We are returning 190,000. That means here we will make break even between year number 2 and year number 3. So how much the 70,000 that's the remaining for the 450, how much is this one from 190? So we need to divide 70,000 by 190. It will give us 0.4 here. That means the payback period is 2 years and 2.4 years. Okay, this is the payback period. So this is related, but please be careful. This is a very serious, this is a very important topic, and please, you need to know exactly how can you find the payback period and the net present value. So you need to practice. I will send you this Excel sheet, and you try to see how did I find this one and this one. Okay, so now we will go to the net present value. The decision rule here is very simple. If the project has positive net present value, then it will be accepted. But if the net present value was negative, then we will reject this project or this investment. If we have 2 or more projects, then the maximum or the highest net present value, the best will be the project or the investment. Why NPV is better than accounting rate of return and payback period? Because the timing of the cash flow is considered here. That means if we receive, as you saw before, if we receive 190,000 after 1 year, this 190,000 will be today, with today's prices, will be 131 and 700 like this. So it will be discounted because of the inflation, because of the interest, and because of the risk premium. Because of these 3 factors, it will be discounted. That means if you receive 1 riyal after 1 year, it will not equal 1 riyal that you receive it today. It will be less than 1 riyal that you receive it today. And the second reason that make NPV better than ARR and PP or payback period is that all the cash flows are considered. All the cash flows are considered here. And also the third reason is that the objective of the business, which is wealth maximization, is considered also. Because when we count the net present value, we will choose or we will select the highest net present value. That means the highest net present value will be the maximum or the highest wealth we will make from this investment. Okay, internal rate of return is also related to net present value. Internal rate of return, you remember the discount rate that we discussed before in NPV. The discount rate, the IRR or the internal rate of return is the discount rate that give us a 0 net present value. That means when the project give us 0 as net present value, then the discount rate that we use is the IRR. The IRR decision rule, the project must meet a minimum IRR requirement. For example, if we are choosing, or if we are deciding that we need at least 20% IRR for any project, that means if the project's discount rate, or if the project's IRR is less than the IRR that we decide, we will not accept it. If it was higher than the required IRR, then it will be okay. If we have two projects, then the highest IRR will be selected. The project that has higher or highest IRR is the better project. Okay, these are the decision rules, or the decisions, the methods related to investment decisions. For the IRR, there are some problems, like it's not, the IRR is not a direct method. It's indirect method. Okay, and by the way, you cannot calculate IRR manually. You need to calculate IRR using software, using computer, or using, for example, Excel. Okay, Excel can calculate the IRR easily. Okay, but manually it will be very difficult for you to find the IRR.